This earnings season has been a window into how some of the world's largest industrial companies are handling the impact of U.S. tariffs. Joining us now to discuss his view on the sector, David Mao, VP, Director, and Portfolio Manager with TD Asset Management. David, great to have you back on the program.
Nice to be here, Greg.
We have no shortage of deadlines in this world. It feels like when it comes to trade, we are having trade deals being signed. How has it impacted the industrial sector? What are we seeing here?
I think, generally speaking, the industrial companies have had a bit of a difficult time. It's been challenging. Like you said, the uncertainty is really disrupting the normal flow of business. You see some companies where their customers are pulling forward orders, so they're trying to get ahead of the tariffs. And then you see some customers that are delaying their orders because they want more visibility on the tariffs, right? So it's been fairly disruptive. But again, it does depend on which segment of industrials that we're talking about. If we look at some of the companies that are more exposed to, say, domestic reshoring or artificial intelligence, automation, data centers, a lot of those stocks are actually doing quite well. Names like Deere or Caterpillar, Eaton, WSP. These guys are involved in construction, domestic activity, data center. Those stocks are trading at or near all-time highs. So it hasn't been that bad for them in terms of share price reaction. But then we have other companies like rails or airlines. Those guys are more levered to consumption trends and cross-border trade. Those guys have not been doing well at all. So it really does depend on which segment of industrials or sub-segment that we're talking about. But overall, I think these tariffs haven't been good for anyone. Just some companies have performed better than others.
All right, let's start breaking them down then by those baskets. You said some are doing better than others in this environment. Let's start with the rails. What have we been hearing from those companies?
Yeah, most of the rails, or pretty much all of the major Class 1 rails, have reported their second quarter results over the last week or two. We start with the Canadian guys. CN Rail reported somewhat of a lackluster result for Q2. I think revenues were down a tiny bit or close to flat. Earnings were also flattish, I would say. The good news for CN is that they did improve their efficiency ratio, so they're making progress on profitability, which has been positive. CP just came out yesterday. Their results were actually much better than CN. They had growth in the top line, they had growth in volumes, they had growth on earnings. I think some of that is a result of the merger that they did with Kansas City Southern a couple years ago. So their network is, I would say, relatively stronger than what CN has right now. But at the end of the day, they're still being impacted by tariffs. Turning to the U.S. rails, UNP reported a fairly decent result in Q2. The other major Class 1 rails would be CSX and Norfolk Southern. They had softer numbers. The outlook hasn't been great. But I would say all of this has been overshadowed by the recent announcement that UNP is going to take over Norfolk Southern. And that's a very big announcement. I think that's going to create a truly transnational rail network across the United States. And in fact, I think it's the biggest rail merger in the history of rails. So it's a big deal.
And I guess people are always in, when you can see M&A activity like that, gets people interested in the space. That's the rails. What about the airline sector? How are they faring in this environment?
I think the airline sector is fairly mixed. When we saw we'll talk about the U.S. airlines first. The U.S. airlines, when they reported over the last week or two, what we saw was that the airlines that have a heavy exposure or heavy reliance on the domestic U.S. market have done worse. And that's simply because the domestic leisure travel segment in the U.S., those consumers are feeling the pinch of a tougher economy. So they haven't been traveling as much. And we're seeing the airlines start to cut capacity on those domestic U.S. routes and even lower seat prices. Now, on the other hand, the airlines that have more exposure to international travel, so that would be Delta and United, they have more exposure to international routes versus, say, someone like a Southwest or an American Airlines. They're actually doing okay. they're seeing continued strong demand for international travel, continued strong demand for premium cabins, so your premium economy, your business class, your routes to Europe. Those are all still growing pretty good. And so we're seeing airlines add capacity on those routes, and they're even able to maintain or improve pricing on those seats. So it's it's a bit uneven. It depends on where exactly a particular airline has more exposure.
So what kind of customer they're catering to, right?
And what kind of
if you're flying
customer?
business or premium, then you got some money as well.
Yeah, so the higher end customer seems to be a lot more resilient right now than your basic economy, I guess, travel customer. And that's kind of been the trend that we've seen since the first quarter, even the fourth quarter last year, and that continues. I think the question is, how much longer does that premium segment traveler, how much longer can they continue to spend if the economy continues to get worse?
Okay, so that's we've done rails, we've done planes. Let's get to the autos. We've seen trade deals now, the U.S. and Japan, now South Korea. What does that mean for the auto sector?
I think, speaking to the Japan and Korea, I guess, trade agreements, it's quite good for those automakers. So your Toyotas, your Hyundais, your Kias, Hondas. It's been, and those share prices have gone up when those deals were announced. It's not, I think, that great for the American automakers, because when you look at the big picture, if Japan-made cars are being tariffed at a 15% rate, whereas I guess American-made cars, where a lot of those cars are made in Canada and Mexico, are still being tariffed at a 25% rate, with the possibility of that going up to 35%, the American automakers are going to be at a disadvantage. And the other thing is, when the Japan trade deal was announced, I guess it was last week or possibly this week, one of the parts of the deal was that Japan would remove trade barriers for American cars to enter Japan. Well, we know that in the U.S. and America, there's definitely appetite for Japanese-made cars being imported to America.
Does this go the other way? Yeah.
Yeah. So the question is, even though trade barriers have been removed in Japan for American-made cars to be exported there, is there really an appetite in the Japan domestic market for a Ford or a Chevy or an American OEM to really gain any kind of market share there? I think that remains to be seen.